Okay, you're thinking to owning a bank. From the outside, it can look like an unusually powerful business. Customers bring you deposits, borrowers pay you interest, businesses use your payment services, and the institution earns money from financial activity happening every day. But a bank is not a normal storefront with a vault attached. It is a leveraged, heavily supervised balance sheet business where a small mistake in credit, liquidity, interest rate risk, compliance, or funding can destroy years of value. So the real ownership question is not simply how much money a bank can make. It is how much capital you need, what permissions you must obtain, where the earnings actually come from, what keeps those earnings from becoming profit, and what can make a seemingly healthy bank fail very quickly. If you want to start one in the United States, the first surprise is that there is no single national price tag that buys you permission to operate. A bank needs a charter from the appropriate state authority, or for a national bank, the Office of the Comptroller of the Currency. If you plan to accept federally insured deposits, you also need approval for FDIC deposit insurance. Organizers must present a serious business plan, identify qualified management, show where the capital came from, explain the target market, describe lending and funding strategies, build compliance systems, and demonstrate that the institution can operate safely. That makes the startup budget much more complicated than saying, bring $20 million and open the doors. Current FDIC guidance focuses on whether initial capital is sufficient for the proposed institution and whether the bank can maintain a Tier 1 leverage ratio of at least 8% throughout its first 3 years. The actual dollar amount therefore depends on the size, risk profile, growth plan, expected losses, and operating model. A narrow community bank and an ambitious digital bank can require very different capital plans, even before either one has a customer. And capital is only one bucket. Before opening, organizers can spend heavily on attorneys, accountants, technology vendors, cybersecurity, compliance staff, consultants, core banking systems, office space, insurance, recruiting, audits, and months of payroll before revenue reaches a useful scale. A new bank also needs working capital because the business can consume cash while its deposit base, loan book, and fee income are still developing. None of those expenses should be confused with regulatory capital. One keeps the operation running, the other helps absorb losses and protects the institution's balance sheet. This is the kind of ownership economics we break down here. Not the impressive revenue number, but the machinery underneath it. Because with a bank, the machinery matters more than almost anything else. There is another route. Instead of organizing a bank from zero, you can acquire an existing institution or controlling interest in one. That can give you an operating charter, an existing deposit base, employees' systems, branches, or digital infrastructure, and a loan portfolio on day one. But buying a bank does not mean buying your way around regulation. Bank combinations and changes in control can require regulatory filings and approval. And the purchase price is only the beginning of the analysis. A buyer has to examine the quality of the loan book, concentration risk, unrealized losses in securities, deposit stability, interest rate sensitivity, pending litigation, cybersecurity, compliance history, vendor contracts, commercial real estate exposure, and whether key customers may leave after the transaction. A bank that appears cheap compared with its book value can become expensive if loans default or depositors demand higher rates. A bank that appears expensive may have unusually valuable low-cost deposits, strong local relationships, clean credit, and a defensible market position. So, acquisition value is not simply assets multiplied by a convenient industry number. Now we get to the part that makes banking different from most businesses. The balance sheet itself produces the product. When a commercial bank makes a loan to a non-bank customer, the transaction can create a new deposit. If the bank approves a business for a $100,000 loan and credits the borrower's account, the bank records a $100,000 loan as an asset and a $100,000 deposit as a liability. That does not mean the bank can create unlimited money without consequence. It still has to manage capital, liquidity, credit risk, funding, interest rate exposure, regulatory requirements, and payment obligations to other institutions. If the borrower transfers the money to another bank, the lending bank must settle that payment. If depositors leave, the bank needs liquid resources or reliable funding. This distinction matters because an old simplified story says, banks merely take one customer's deposit and hand the same dollars to another customer. Deposits do help fund banking activity, but modern bank accounting is more dynamic than passing envelopes of cash from one person to the next. The Federal Reserve also reduced reserve requirement ratios on net transaction accounts to 0 in March 2020. That fact is real, but it does not mean banks operate without constraints. Reserve requirements are only one rule. Capital requirements, liquidity management, supervisory expectations, credit standards, internal risk limits, market funding conditions, and the basic need to meet withdrawals still matter. A bank that makes poor loans cannot solve the problem by pointing to a zero reserve requirement. So where does the owner's economic return begin? Start with net interest income. Banks earn interest on loans and securities, and pay interest on deposits and other funding. The difference, after comparing interest earned with interest paid, is net interest income. Net interest margin, or NM, expresses that relationship relative to earning assets. In the first quarter of 2026, the FDIC reported a 3.71% net interest margin for community banks. That is useful as an industry reference, not a promise for a new bank. Why can two banks with the same asset size produce very different results? Because one may fund itself with stable, relatively low-cost checking accounts, while another has to pay aggressively for certificates of deposit or wholesale funding. One may hold well-priced business loans. Another may own low-yield securities purchased when rates were lower. One may have excellent credit performance. Another may be losing interest income because borrowers have stopped paying. Suppose your bank has $400 million of earning assets. A margin near industry levels might make the revenue engine look attractive on paper, but NM is not net profit. From net interest income, the institution still has to absorb credit losses and then pay employees, technology vendors, compliance teams, fraud operations, data providers, insurance, rent, legal expenses, audit costs, marketing, card processing expenses, cybersecurity costs, regulatory assessments, and taxes. If you financed the acquisition, debt at the holding company or investor level can further reduce what ultimately reaches owners. Then there is fee revenue. Depending on the bank, non-interest income can come from payment services, card interchange, account services, wealth management, treasury management, mortgage activity, loan origination, merchant services, trust operations, or other permitted financial services. Those businesses can diversify earnings, but they also require infrastructure and create their own compliance and operational risks. Credit cards are a good example. Federal Reserve data released in August 2026 showed that commercial bank credit card accounts that were actually assessed interest carried an average rate of 22.15% in the latest reported period. That sounds enormous next to many other lending products, but the interest rate is not the same thing as the issuer's profit margin. Card issuers face funding costs, expected credit losses, fraud, rewards, servicing, customer acquisition, technology, regulatory costs, and the fact that many customers pay their statement balance without incurring revolving interest. A bank, therefore, wants more than high rates. It wants correctly priced risk. Consider two customers who each borrow $10,000. One has stable income, low existing debt, and a strong record of repayment. The other is already stretched and is much more likely to default. Charging the second customer a higher rate may compensate for some additional risk, but if expected losses become too high, the higher yielding loan can be less valuable than the lower rate loan. This is why underwriting is not a boring back office function. It is one of the core engines of bank profitability. A community bank may know its local market extremely well, but concentration can quietly build. Perhaps a large share of the loan book is tied to apartment projects, hotels, agriculture, energy, office buildings, or one local employer. If that sector weakens, individual loans that looked reasonable can start deteriorating together. When borrowers stop paying, the problem hits income first through missed interest and then capital through credit losses. Commercial real estate illustrates the point. An office loan is not just a loan against concrete and glass. Its repayment may depend on tenant occupancy, lease renewals, property cash flow, refinancing conditions, interest rates, and the market value of the building. If vacancies rise and the owner cannot refinance on workable terms, the bank may be left with collateral worth less than expected. Owning a bank means constantly asking whether the asset side of the balance sheet is as strong as the accounting statement makes it appear. That is the lesson from Silicon Valley Bank in 2023. SVB had grown rapidly and held a large securities portfolio, while serving a depositor base heavily connected to technology and venture capital. As interest rates rose, the market value of long-duration securities fell. On March 8th, the bank announced a balance sheet restructuring and planned capital raise. Depositors reacted with extraordinary speed. The Federal Reserve's later review documented deposit outflows of more than $40 billion on March 9th, with management expecting vastly more the following day. The institution was closed on March 10th. For an owner, the lesson is not that government bonds are inherently dangerous. The lesson is that asset duration, funding behavior, depositor concentration, unrealized losses, and liquidity have to be managed. Together, a bank can be solvent on a long-term, hold-to-maturity view and still be unable to survive a sudden demand for cash if it cannot turn assets into liquidity without unacceptable losses. Digital banking makes that risk faster. Depositors do not need to form a line outside a branch. Large balances can move electronically in minutes. That brings us to deposits, which are much more than money sitting in customer accounts. Deposits are funding. Their cost, concentration, insurance status, customer behavior, and sensitivity to interest rates can determine the value of the entire franchise. A bank with thousands of smaller, stable consumer and business relationships may behave differently from one funded by a relatively small number of large, rate-sensitive accounts. If customers believe they can earn materially more elsewhere, the bank may have to raise deposit rates. That increases interest expense and compresses margin. If the bank refuses, deposits may leave, and liquidity pressure rises. FDIC insurance helps support confidence, but it has limits and a specific purpose. The standard insurance amount is generally $250,000 per depositor, per insured bank, for each account ownership category under the applicable rules. The insurance protects eligible deposits when an insured bank fails. It is not a general insurance policy for every loss involving a bank, and it does not turn poor management into a safe business model. Banks also protect themselves from operational losses through controls and private insurance arrangements, including fidelity coverage where required or appropriate. But insurance should never be treated as a substitute for controls. Fraud can come from outsiders through stolen credentials, fake identities, check fraud, cyber attacks, payment scams, and account takeover. It can also come from insiders with legitimate access. The owner's real defense is layered. Segregation of duties, transaction monitoring, access controls, audits, employee screening, vendor management, cybersecurity, escalation procedures, and a culture where unusual activity is investigated instead of ignored. Linda and her investor group are evaluating a small community bank with approximately $500 million in assets. The group does not start by multiplying assets by a fixed percentage. Instead, it builds a quality map of the institution. First, they separate loans by type, geography, borrower quality, maturity, rate structure, and collateral. Next, they examine deposits. How much comes from local households, operating businesses, brokers, large uninsured accounts, and customers who move money whenever rates change. Then they study securities, liquidity, capital, credit losses, technology obligations, staffing, compliance findings, and the cost of retaining key employees. Assume the bank's earning assets produce a net interest margin around the recent community bank range. That can generate meaningful net interest income, but Maya's group refuses to call it profit. They subtract expected credit losses and operating expenses. They stress the model by assuming deposit costs rise. A few commercial borrowers weaken, and technology spending comes in above budget. They also test what happens if growth is slower than expected. The result is revealing. The bank can remain profitable in the base case, while producing much less cash for owners under the stressed case. That difference influences what the group is willing to pay. Now change only one fact. Suppose the deposit base is exceptionally stable and relatively inexpensive because the bank has deep relationships with local operating businesses. The franchise may be worth more. Change another fact. Suppose a large percentage of deposits comes from a handful of customers with balances far above insured limits. The same headline asset total may deserve a lower valuation because funding can disappear faster. There is also a major difference between owning the bank and working inside it. If you are part of an investor group, a bank holding company, or a board, professional management may run the institution. That does not make ownership passive. Directors and controlling owners operate within a governance system where management quality, risk oversight, internal controls, and regulatory relationships are central to value. If you personally take an executive role, then your compensation should be separated from your return as an owner. A salary is payment for work. Dividends or appreciation are returns on capital. Mixing those numbers can make a mediocre investment look better than it is. Growth creates another trap. A bank can grow deposits and loans quickly while becoming less valuable. Rapid loan growth may require more capital. New markets can bring weaker underwriting, unfamiliar borrowers, aggressive pricing, and higher operating costs. Fast deposit growth may come from expensive promotional rates or concentrated commercial accounts that are not loyal. A rising asset number can therefore hide declining quality. Technology changes the cost structure too. A small bank once competed mainly through branches and personal relationships. Now customers expect mobile deposits, instant alerts, online account opening, reliable cards, fraud controls, fast transfers, cybersecurity, and near-continuous digital access. That means a community bank may need sophisticated technology even if it serves a small geography. Outsourcing core systems can reduce the need to build everything internally, but it creates vendor dependence and does not outsource the bank's responsibility for risk. Compliance is similarly unavoidable. Banks operate under rules covering safety and soundness, consumer protection, anti-money laundering obligations, sanctions, fair lending, privacy, information security, and many other areas depending on the institution and products. The cost is not only software, it is people who know the rules, test systems, investigate alerts, train employees, document decisions, respond to examinations, and fix weaknesses. These expenses explain why scale can matter. Some costs rise directly with customer volume, but other costs exist simply because you are a regulated bank. A larger institution may spread core technology, audit, legal, compliance, executive management, and cybersecurity costs over a bigger base of earning assets. A very small bank can be well run and profitable, but it has fewer dollars of revenue over which to spread those fixed costs. So what does a good bank actually look like economically? It has enough capital to absorb losses without choking growth. It has diversified, understandable assets. It funds those assets with deposits and other sources that remain reliable under stress. It prices loans for credit risk and funding cost instead of chasing volume. It keeps enough liquidity to survive withdrawals. It controls operating expenses without starving compliance or technology. It earns fee income where it has genuine capability. And, most importantly, it produces returns after expected losses and overhead, rather than only showing impressive interest revenue. The branch can be clean. The app can work. Customers can be depositing money. Loans can be growing. Yet beneath the surface, deposit costs may be rising faster than loan yields. Securities may have large unrealized losses. Borrowers may be weakening. And capital may be getting thinner relative to risk. As of the first quarter of 2026, FDIC-insured institutions as a group were profitable, and community banks reported a 3.71% net interest margin. But industry-level profitability does not tell you what one new bank or one acquisition will earn. The exact economics depend on its assets, funding, operating costs, capital, credit quality, management, geography, product mix, and purchase price. And failures have not disappeared. They are uncommon relative to the number of insured institutions, but they still occur. The practical goal of ownership is not to maximize the spread this quarter. It is to build a balance sheet that can survive the next bad quarter, the next funding shock, and the next credit cycle. So, should you start a bank or buy one? Starting from scratch gives you the opportunity to design the strategy, culture, technology, and credit box from the beginning. But you face the chartering and deposit insurance process, capital requirements, pre-opening costs, management recruitment, systems build-out, and the challenge of attracting enough deposits and quality borrowers to cover fixed costs. Buying an existing bank gives you a functioning platform and relationships immediately. But you may also inherit legacy loans, expensive branches, old technology, compliance problems, concentrated deposits, weak contracts, and balance sheet risks created years before you arrived. The acquisition can save time while transferring old mistakes to the new owner. The final ownership equation is less glamorous than the movie version of banking, but much more interesting. You are not really buying a vault. You are buying a regulated system for taking funding, extending credit, moving payments, managing risk, and maintaining trust. The asset that makes money is the balance sheet. The liability structure determines whether that balance sheet can stay funded. The people and controls determine whether the risk remains understandable. And the capital determines how much damage the institution can absorb before owners are in trouble. If those pieces are managed well, a bank can become a durable, valuable business with recurring interest and fee income. If they are managed badly, high revenue and rapid growth can actually make the institution more fragile. That is the economics of owning a bank. Not free money, not a vault full of customer cash, and not a guaranteed spread between deposits and loans. It is a business built on leverage, disciplined underwriting, stable funding, liquidity, regulation, technology, and trust. And the owner who understands those constraints has a far clearer picture of what the bank is really worth.